Hello, I'm Gary Kroll from Sequoia Financial Group and the Financial News Network, and today I'm excited to be speaking with Allan Mason. Allan Mason has 40 years of tax and accounting knowledge and has assisted many thousands of corporate and private clients, including some of Australia's wealthiest individuals, including what piqued my interest when I first saw his book, Kerry Packer at the Height of His Wealth. Allan has just released the fourth edition of his Tax Secrets of the Rich 2024-2025, which outlines a number of tax tips relevant to millions of Australians. Welcome to the network, Allan. Pleased to meet you.
Thanks, Gary, and thank you for those kind words. Yes, 40 years, a long time, isn't it?
It is. I'm very similar in financial planning. So, time flies, and I'm sure you do, like I do, remember when we were the young guys of the industry, but now we're sort of more senior.
Exactly. In the young days when Kerry Packer was World Series cricket and everyone was shaking their head about the losses, and up before the Senate committee casually stirring his tea while the senators making snide remarks about him, that Kerry really put him in his place. So, they were the days. They were different than today, Gary. Absolutely,
and I think we all remember the song, the World Series cricket song, talking about different bowlers coming in and people hitting sixes. It was an amazing marketing campaign at the time.
Yes.
Allan, one of the things that people talk about, death and tax, that are considered the two certainties in life, and you've written a book about one of them, which is titled The Secrets of the Rich in Respect to Tax. You practice as an advisor in Queensland, and as we touched on, you're a Kerry Packer's advisor and accountant. So tell us what it's like as an accountant working with that type of client, the very high profile, famous people like Kerry Packer, who has famously been looked on Google in respect to his discussions in Parliament about tax and the amount you should pay. So, what brought you to that space, and tell us a bit about that.
Well, of course, Kerry's famous quote is that the government doesn't spend the money too wisely.
What the Four Corners program suggested was not that you were evading tax at all, that would have been libellous, but that you were minimising tax.
There's nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax.
And that you were doing so in ways that were contrary to the spirit of the law.
Oh. Well, I just got through telling you what I thought about that. And what you're saying is exactly what the Four Corners program says. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you're not spending it that well that we should be donating extra.
Honestly, that has resonated throughout my career. And Kerry, people talk about high net worth people, and there's a few people whose names you would know that I look after. And I look after their personal wealth. And to the outside world, some of these people are seen as really nasty and difficult people to deal with. But at my end, they are not. They are respectful. They are helpful. I was with one of my clients yesterday that was in BRW Rich 100. We sat on the kitchen table. We're going through some issues. It's a different world at my end. And Kerry said to me when he first hired me, and it is true of all high net worth people. Kerry said, "Son," and I said, "Yes, Dad." I said, "No, I didn't want to say yes, Dad." But he said, "Son, you've got to be worth double what I pay you. So at the end of 6 months, you either get a rise or you're out." So that was, and I was with him quite a number of years. So if you've got the right attitude, if you're the right kind of person, and if you're the right work ethic, I suppose, and you're in accord with the way they think, they're like friends. And you see this with all high net worth people. Their advisors are with them forever because they become like a friend. And some of the people will ring me and I say, "No, you can't do it there. You've got to put it this end. You've got to put it over this end. We've got this happening over here." I'll know that better than they will because, we're talking someone that might have 20 or 30 entities.
Yes.
Allan Bond, for example, and I don't act for Allan Bond, the late Allan Bond, had 248 trusts. So do you think he could remember all those? Why did he do that? He was able to go bankrupt twice, yet still be in rich BRW.
Yes. Well, I think he couldn't remember anything at one stage about the trust, isn't that right?
Yeah, well, that's another story.
That is, but an amazing and great Australian, absolutely. I believe you've been quoted as suggesting many taxpayers are quite lazy in respect to the tax. And, as Sequoia is sort of known as a financial planning business, we have responsibility to know the client, provide a document referred to as a financial disclosure statement before people consider receiving advice. And the accounting industry is probably not as regulated in respect to fee disclosure and knowing the client. So one of the books I know that you've written as well, in addition to this one, is how to choose an accountant. So have you got any advice on that for the consumer? How to choose an accountant and determine the difference between someone who's going to get to know you very well, understand all your needs, and be very personal, like you've just touched on, in respect to the advice you give.
Exactly, Gary. And one of the big things about choosing any advisor is, firstly, that they know their stuff. Now, a client is not necessarily going to know that, so they're going to have to ask a few questions about their structure, and they need to glean whether the person knows what they're talking about. A couple of simple tips. One is that the accountant needs to be computer literate. Now, that might sound funny, but I can tell you many, many occasions where a lot of accountants, a lot of people are not very computer savvy. So hence they get caught up and they have to use their secretaries and other people to do things for them. It indicates a mental issue to me. Maybe that's not the right way to express it, but it indicates to me that they're not progressive in the way they think. Change occurs so quickly today that you need to be on top of it. The only way you're on top of it is through IT. The only way you're on top of it is by keeping abreast of what's occurring and being able to be quick on your feet. And so there's the underlying ability, knowledge, but there's also got to be a personal side. An accountant is very close to a client, and we know a lot more than you would know as a financial planner with a client. And we need to be able to discuss things in an environment that is not threatening, and they need to tell me things that they may not want to tell other people. And I might want to restructure something a certain way to handle that. So there is a little bit of a personal aspect. Remember, your accountant is a team member. He's part of your team. And you need to get the right person on the team.
Yeah. Well, one of the things of financial planning industry that we are disappointed in is that not enough people have a financial planner. I think the current statistics say that 16%. A lot of people don't have an accountant or a tax agent either. There's people going online trying to do their own tax, or they have a friend do it. Someone who's not a professional. What's your thinking on the cost benefit analysis in respect to why you should have the accountant, and the point of how do you choose your accountant, whether you're a mum and dad, a small business, a large business, or a high net worth client like some of the people who choose you are. So what's the thinking around that?
You can use Google to an extent. I mean, Dr. Google is the bane of contention for doctors because people do all their self-analysis. The problem is we're dealing in a world that's complicated, that when it comes to accounting and tax, all of a sudden they'll be Googling and think they've got the answer, but it's an answer in India or something that doesn't apply to Australian law. So you can get yourself into a massive problem. The other issue I see often is people have a trust or a company and they do a tax return. They don't do financial statements. And with the financial statements, that's the balance sheet. So you're not getting any unpaid present entitlements. You're not getting any issues with Section 101 with 101A to do with reimbursement agreements in trusts. So you're not producing a loan account within a balance sheet that shows who's owed what and how I can distribute or how I can pay that physical distribution. You're just doing a tax return. People will sometimes, not so much now, they come back and say, oh, look, we don't want you to do financial statements. We just want to do a tax return, lodge tax return. I go, well, hang on, it's a company. We've got money in and out. How are we going to reflect the balance sheet off that? And you would be familiar with Div 7A.
Yes, and the loans and the penalties, etc. Yes.
So you've got a company and you go, okay, I'm going to flow out all the profit into my own pocket, but I'm only going to show a wage of X amount of money. Well, if you don't do financial statements correctly, you're not going to show that Div 7A loan, and you're going to get a deemed dividend under Section 108, where you'll pay tax on that, and it will be an unfranked dividend. So people can get themselves in a massive hole and a massive problem if they don't get the right advice and they don't do things correctly and have someone that just knows the structure and can in 2 seconds tell you yes or no, that's not what you can or can't do.
Yes. Yeah, no, it's a shame that, the press tend to focus on the negatives, but the real value of advice is unquestionable. And it would be good if we could see more people talking about, and reading books like your own, so they'd actually realise that getting advice from a professional person that can actually save them a lot of money is in their best interests.
I tried to cover every area in my book in a simple way, and most people have said that my book is easy to read.
Yes,
I tried to make it that way because, and that's another thing about advisors too, that sometimes if you get an advisor, I could talk to you for 10 minutes, you wouldn't understand a word I said. So sometimes advisors can be too complicated, too theoretical, and too difficult to understand. And I think if you've got someone that you go to that can't explain it in layman's terms, they don't know this stuff. I've tried to do that. I've done that in my book, and I believe I've been very successful in it because I've often asked people for is there any way I could make this book easy to read? Is there anything that's in there that's a waste of paper or that I should cut out? And most people said no, they loved every bit of it. And it was easy to follow and it was easy to understand.
Yeah, no, it's a credit to you. It's also available for people like me who are lazy and is on Audible, I noticed, which is terrific. One of the things you touched on before was, and I actually wouldn't mind mentioning your website too, which is also a credit to you, www.allanmason.com.au. You've got a lot of tips on there, which, some would be in the book, but, just on your website, that jumped out at me was The Stranger's Secret on your website. The other one was the Albert Einstein comment about XY plus Y equals Z, and Z is listening, and etc. But the Stranger's Secret one really resonated with me from a financial planning perspective. 100% of people want a secure retirement, but their current situation suggests that they're not going to get it or they're not doing the right things about it. What's your thinking about superannuation? Do you still believe as a tax person that that's the most tax effective structure for Australians to save for retirement?
I definitely do. It's a tax haven. Superannuation is a tax haven. And it's like putting money from your left pocket into your right pocket and getting a tax deduction on the way through. So people underestimate it. And we need to build up an amount in super to at least provide some form of retirement. Self-managed fund, or whether it be industry or whatever it is, it's an area that people do underestimate. They say the complexity is too much, it's got to be audited, it's got to be this, that, and the other. It's a lot of rubbish. Yes, you've got to do all those things, but the benefits, can you imagine having, or at the moment, cap 1.7, is it 1.7, 1.9, is sitting there tax-free. All the income, tax-free. Capital gains, tax-free. So we're in accumulation mode up to reach preservation age. So taxed at 15% on income. Most people are taxed at 45%. at the marginal rate. So now we're 15. We can't touch it. Fine, that's good. So it sits there. It's an advantage from a liquidation or a bankruptcy point of view. So what better environment? Let's build up to the nest egg and up to the cap. 3 million is the cap for the extra 15%, applies next year.
Yes.
But let's not be shy away because it's got a bit of complexity. It's an environment, and I've got super, I've got a self-managed fund, I've got rental properties in there, I've got a share portfolio. My rental property has just gone up a massive amount, zero tax. You know, and I talk about, I even talk about an example where we had a client where we put a business into the fund, and you've got to be careful about this. There's rules about it, but the case study is in my book about how we was bed and breakfast, and owned the super fund bought the goodwill for the bed and breakfast. Income's all tax free. It's in pension mode, and the amount that she draws out as a wage is tax free because it's in pension mode. You know, you just got to use it. And it's the same with trusts. You know, you can pull out distributions from trusts to family members, to your wife, or grandparents, or whatever, up to the tax threshold, tax free. You know, and various rates as you move up the tax scale. So you got to create that nest egg for the future.
And do you think the tax structures like the trusts and company structures are just for the rich, or you think you know, more Australians should be looking at you know, the family trust and etc.?
There are times where they suit, and there are times where they do not suit. So if you've got a loss, let's say you've got a rental property and you're going to incur losses in the first 4 to 5 years, you probably would not put that in a trust. You'd put that in your own name, because then that loss would be offset against your salary and wage income. Conversely, if you were to build up a rental portfolio of properties where you might start to accumulate commercial properties, 4 or 5 commercial properties that are going to give you a nice passive income, you'd probably want to do that through a unit trust. Or you might want to put it through a discretionary, but probably I'd suggest a unit in that example. But it depends on the structure. It depends what you're doing. You need to have volume to make it worthwhile. There are some situations where you're better just to be in your own name and not incur the costs. As you get a little bit bigger, or if you're at risk, if you're a doctor, for example, and you might be at risk of being sued, or a lawyer, you might want to then shelter your assets in an entity.
Yes, interesting. And you know, one of the things that everyone is frightened of is when the tax department comes and knocks on your door and asks you to have an audit or disagrees with a return that you might have lodged. So how do you handle that? Because you're obviously dealing at the top end where there's a lot of eyes on those individuals, and the communities has a negative view on the rich not paying enough tax. So how do you handle the disagreements or the audits from the tax authorities on behalf of your clients? Because that to me would be a big issue.
I've had many audits, been involved in many, and in fact, in my book, I've mentioned a lot of case studies where people have done things. And sometimes, can I tell you, in my career, and it spans a long time, 40 years or more actually, people don't always tell me what they're doing.
Yes.
They might have done something, and there is an example in my book where a person had ski lodges and had a lot of cash.
Sounds like someone I might know, yes.
Yeah. And he didn't tell me exactly what he was doing, and he got audited and he got into a lot of strife. Whereas I had other clients where they have come clean about what they might be doing. They might have had a restaurant with cash again and have come clean. And I've then come clean with the tax office and made a full disclosure. The first thing the tax officer will say at the initial meeting is there anything you wish to declare? Is there any disclosure that you want to make? And it's usually before that I would say to the client, is there anything you haven't told me?
Yes.
And then we will handle that, and we will handle it in a respectful way. So in one example, we did that disclosure. Tax office asked exactly that question. It's in the list of rule book what they have to do. And I said, well, in fact, there was a bank account in that we didn't know about, that the client said that they just cash went in there and they paid out expenses out of it with a wash account. They didn't think they needed to declare it, et cetera, et cetera. And I thought, yeah, right. But so anyway, so I said, we've got this bank account that we're going to disclose. We've already gone through and amended all the BASs for the 4 years that are related to. Here's the amendments. And I'll push them across the table and said, this is the bank account at NAB and whoever it was. We've done all this, and the client went through what he thought the excuses were. Tax office said to me, Bill said, we knew about that bank account. We knew that one existed. Thank you for doing the work for us.
Yes.
That client did not get fined. He did not pay interest. We got all the interest remissions. He did not get fined. No issues at all. The previous guy that owned the ski lodges was a bit arrogant about it. He was of nationality that was a bit arrogant about tax. And he ended up paying massive fines and going to jail.
Yes.
So you've got to handle this correctly. You've got to handle it respectfully. I'm dealing with a large audit at the moment. It's what the tax office calls the next 5,000. Next 5,000 high net worth individuals. And they're working down the schedule on a list. And this audit has been going for 2 years, and I've been handling it. Everything respectfully, everything honestly. This guy doesn't receive any cash. There's nothing on the table or anything like that. It's just he's had poor advice and his structure was bad, and I've restructured him. But he only came to us as a client late last year, and I was the third accountant he went to be honest.
Yes.
And I had to fix a problem that no one else could fix, and I did fix it.
Yeah, you know, what you're saying seems consistent with my understanding as well. It's the tax department are actually very good to work with if you're honest and respectful and upfront. And people do make mistakes, and people do the wrong things. But if they do look to repair that in a respectful manner, the tax department are good people generally, I believe. Yet I don't think that perception's held in the community very well.
Exactly. And in most cases, we can get either full remissions of interest. In that example that I've just talked about, the one we're doing now, we got back remission of 1.8 million in fines and penalties. And some of the problem was, in fact, the tax office problem. The pre-fills were wrong.
Yes.
I mean, that might sound odd, but the pre-fills were wrong, and the auditor said to me, yeah, I know we had a bit of problem with the TFN at one stage. And that's why, and I had to ask the tax office, what were the divs that came through to these entities, and because what was coming up on pre-fills was not right, and even the figures the tax office had were not right. We had to go back to the share register and get the right information.
Yes.
So we're just working together, and doing it correctly and honestly. And like in Kerry's day, for instance, if there was a tax bill to pay, just pay it. And when you get up, and one of the things I talk about in my book is managing your affairs in the right way to build wealth. And when you get to a point where you've built enough wealth, then you don't care anymore about if there's a bit of a tax to pay. You manage it, of course, and minimise it as much as you can. But if that's the bottom line, that's the bottom line. Just pay it.
Yes. The comment about the more you make, the more tax you should pay and you should be happy is probably incorrect, but paying the right amount, I think, is important, isn't it?
Exactly. And look, there's two myths I talk about all the time. One of them, two myths, death and taxes. Well, having worked for Kerry for a lot of years, I can tell you there's only one, and that's death. Taxes can be managed. So that's a myth. Two things certainly in life, death and taxes. No, actually, there's only one. And the other is, the more money I make, the more tax I pay. That's not true either. I can tell you there's thousands of ways, well, maybe not thousands, but a few hundred ways that you can restructure events. We talk about super. More money I make, the more tax I pay. No, if it's in super, it's tax-free. So that's not true.
Yes.
50% CGT discount for rental property,
Yes.
100% rollover relief where you roll a capital gain from sale of a business into a super fund. You made the money, but no tax on that.
Yes.
Active asset test, 50% reduction and a 50% CGT discount. So you sell a business, you've got about 3 to 4 different tiers of ways of making that gain totally tax-free.
Yeah, I'd hate to imagine the amount of people getting advice when they're selling their businesses that don't take into account these things and the different outcomes based on how you structure the deal. It's just, it's mind-boggling.
We had a client come to us that had done it incorrectly. They were rolling over the gain into super. And he said to me, I put it into my own name because I was going to get a higher interest rate. And then when the 2 years came up for me to do it, I'll take it out of my own name, my own IBD account, put it in super. I said, you can't do that. The entity that made the gain has got to roll it over. I can't roll it over to you and then you pay it to the super fund.
Yes. Yes.
And I said, well, you know what, get an extra 1 or 2% interest, you've sacrificed the capital gain.
And they say, oh, what's the difference? The difference is pretty stark.
It's 200,000 in this case. Yeah.
Yes, absolutely. Thank you for your time, Allan. I would recommend everyone buy your book, maybe read it. If not, listen to it on Audible. And I also would encourage everyone that's listening to actually go to your website because there's some amazing tips on allanmason.com.au that are free. And I thank you for putting that up for everyone to look at.
Thanks, Go. I wrote everything that's on that website. And in fact, I also have another website for books. It's broadviewpublishing.com.au. And you'll probably see a link from the Allan Mason site. So, and a bit of self-help. I've written quite a lot of self-help material, but it is all my material. It is all my IP, if you like. And the strangest secret is, in fact, a tape that comes from Ernest Hemingway in 1934. Ernest Hemingway, I think it was. Yeah, that sounds like the writer. I have to rethink that, but it was 1934 that he did that series.
That's just a little bit before you started.
A little bit.
Thank you for your time. And I, again, encourage anyone who has listened to today's podcast to go on the site and read the book. And as you said, it's written in a manner that all of us can understand, which is terrific and unusual. So thank you very much. Good. Nice to meet you again.
Thanks, Gary.
Okay.
Nice to meet you too.